Welcome back to Money Matters. I'm Emily Johnson, and I am joined as always by DCrowell, and we are here discussing all things where your money matters. We left you at the commercial break discussing a little bit of politics, a little bit of economics. Mostly we've been discussing why this market has been running and what it means to you. And so in our attempt to bring this to something that you can actually act on, that's our goal. So I suppose one of the things that we were discussing between or during the commercial break was a quote that I recently read. It was Ray Dalio's. Well, Ray Dalio said it. I don't know if he originally said it or not, but it was in his book that I read. And it said that he who lives by the crystal ball is destined to eat lots of broken glass. And that's how I feel on a daily basis, because we don't have a crystal ball. I don't actually have one on my desk, thankfully. I don't think that would do a whole lot. So we don't live by the crystal ball. We don't have tomorrow's newspaper or any of those things. So we do our best to manage financial pictures, financial plans, assets and liabilities based on where we feel markets are going, but we also manage risk. And that's really the first thing that we do. And we both do that in some way.
We manage risk more than we manage expectations.
Exactly.
There's
no buy button. It's
no, there isn't.
It's more where are the risks and how do we mitigate them first.
Right. That's right.
And then move forward.
And so my job in the mortgage business is I rarely admit this, but it's actually easier than Emily's job, because
I don't know about that.
My side of the equation has a buy button. For the last 20 years of my career, when somebody says, where do you think rates are going, I echo Bob McGinnis, who's the founder of Mortgage Network, which is a $3 billion mortgage bank. Whenever he is asked, what do you think rates are going to do, he says, I have no idea. It's the end of the conversation. In other words, obviously, privately and speculatively, intellectually he has ideas about where rates are going, but he literally doesn't allow them to intrude into his business world.
Right.
He hedges every portfolio of mortgages. The hedge is an even hedge, so that if rates go up, he can sell his hedge and still make profit on those mortgages. And if rates go down, he can sell the mortgages that are at a higher rate and still make a buck. And so when I advise clients, if you came into a mortgage with me and said, well, it's last week it was at 3.99%. That's what it was last week. This week it's at 4.125. Rates have actually gone up in it. What do you think, David? Should we wait and see if they come back down? For 20 years, my answer has been, if you're comfortable and today's rate makes you a winner in life, if today's rate works for you, 100% of the time we should take today's rate. We should not look for a different rate if today's rate wins for you. That's what makes it easier for me than for you, because you're managing a portfolio that's more complex than my.
But by locking in one of your largest expenses, even if it's your mortgage or if it's an investment piece, then at least we can look at what are the cash flows that are going to make that mortgage feasible. So it's lots of little pieces to the puzzle, and that's usually people's biggest piece. So I agree with you, locking in, but it's also interesting how that's changed. And I know that I'm speaking outside of my realm into your realm, but it's interesting how that's changed in the last several years of what type of mortgage you should get. Because right now it seems like, and it has seemed for the last several years, of lock in a 30-year, because it ain't going to get much cheaper. But a decade ago, it was, let's look at a 5-year ARM, let's look at a 7-year ARM. And I guess we learned through the real estate bubble, perhaps the hard way, but it does seem like there's still those options on the table, but rule of thumb is go ahead and lock it in general, correct?
In general, absolutely, because anybody who's been in the business for a while knows that 30-year money with a 3 in front of it is unbelievably cheap. By the way, 30-year money, 30-year fixed rate mortgages with a 4 in front of it is unbelievably cheap. 30-year fixed rate money with a 5 in front of it is absolutely okay.
Well, I think
so we're still very, very low.
I think the key is that it's a known, and we see that in the market. with companies that are reporting saying, well, if I felt more comfortable about interest rates, and I'd feel more comfortable about investing in R&D, I'd feel more comfortable about hiring people. It's the same thing with your life. If you feel like, if you have visibility on what your expenses are, you have visibility
at least on this part of
that
your
part,
life,
then you can see, you can move forward. And if you don't have visibility, then you need to lock in certain portions of it, because it's impossible to navigate your financial life inside of a marshmallow. It's impossible. So you have to have some knowns, and certainly because there's so many unknowns.
There's so many other unknowns.
You never know what's.
I speak in terms of a pivot point. Imagine that one of your feet is attached to the ground. Well, you still have maneuverability, but only in a circle.
Is that just the John Donne poem,
from
right?
that
It's
one foot. Yeah.
The unmoved mover?
The unmoved mover,
Yeah.
that's exactly correct.
That's you.
And that's how I think of it. You pivot around whatever it is you're able to lock in your financial life. That's
Right.
where you pivot.
Exactly.
Everything else kind of jigs and jogs around the periphery
Right.
of that.
And we're guaranteed that there will be a hiccup in the market. That's a guarantee. Whether it's tomorrow or 2 years from now, or I have no idea. And maybe it's 20 years from now, which would be very, very frightening. I think it would feel a lot better if we actually did have a hiccup. Certainly there's plenty of cash that I think would be put to use at that time. But it will happen. So when you plan according, knowing that there will be that hiccup. And it's more of an opportunity. If you plan, then it's more of an opportunity than a cause for fear.
If there's a 3,000 point drop in the market, if 4,000 point, if the market, because that would be,
Which right now is still just, what, 20%?
it would take 23 and change down to 19. What would your planning position need to be today if I said, well, it's definitely going to happen, Emily, sometime in the next 6 months? What would you want someone to have a 20% cash position, 30% cash position? What kind of position would you want them in so they could take advantage of the drop when it occurred?
Well, so taking advantage of the drop and then living through it are two different things.
Correct. Explain that.
So having cash on the sidelines for expenses, whether you consider that, whether it's not a percentage number, it's really more having cash on the sideline to be able to cover your expenses for a period of a bear market, typically about 2 years. So if your expenses are $100,000 a year, then you need to have, call it $200,000 that is readily available to you so that you wouldn't have to sell into a bad market. So that's one part of the pie.
So that's part of the concept, is not having to sell into a bear market to get cash.
And so percentage-wise, who knows? The other portion of that is of your invested assets, how much of that is in cash, and that is going to depend on which, sort of your risk tolerance, what it is that you're looking to get out of your funds. I mean, right now we're pretty low on cash. We have, and most of the analysts and most of the research that we use is somewhere in the neighborhood of 10% or so, because there's just so much momentum that's moving the market. That said, I know that there are certainly other analysts and other investors out there that are higher in cash right now because they feel like they needed to take some money off the table. We'll see some of that stuff happening towards the end of the year because we've had such a great year, and as we're getting into November, December, you'll start to see some more profit taking. You saw a lot of money getting into the market earlier in the year as we continued to run up because a lot of big money managers and portfolio managers needed to keep their funds invested, and they thought, well, maybe the bull run was over. You saw big floods of money into the market. You might see some of that come out as we get to the end of the year if these big investors have had a big run. By and large, from your perspective, the end of the year is a good time to go ahead and do some tax loss harvesting, but I would not run for the hills at this point, regardless of if you saw a hiccup or not.
And from my end, on the bond end, on the mortgage interest rate end, any of you with a 4.5% mortgage or higher need to call in as soon as you possibly can, and we'll lock in a refinance for you that puts a couple of $100 a month or more into your pocket. So if you're at 4.5% or higher, give us a call ASAP. The rates are slowly moving, and we'll
Now's the time.
set you up.
All right.
Yeah.
Sounds great. Well, thank you very much for joining us again. This has been Money Matters. Please send us your thoughts, issues, concerns. Check us out on Facebook. Give us a call with any questions or comments that you have. We'd love to hear from you. Until next week, have a wonderful week.